how many calls am I along at the 120 strike? And I look at it, I'm like, 58. And he just like makes this snarl, like it looked like he was going to turn into the Hulk. And he comes storming out of the pit and he grabs the thing from me and he looks at it and he goes, no, it's 172. Throws it on the floor and walks back into the pit. And I'm like, what?
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hello, Wealth Building family. Welcome to episode 22. Hey, Butthole. But before we jump in, let's talk about how you can get the most out of the Wealth Building with Options community. First, consider sharing this podcast with like-minded people. Word of mouth is the best way to grow our community for all of us. And the more people you share ideas with and get frequency bounce back from, the more you grow as a trader. The second thing you can do is to support the show with a paid subscription. For the cost of one fancy Starbucks once a week, you'll get video extra podcast episodes and option trade posts where I drop into the deep end of the market, share trade rationales, and chronicle my covered call and cash secured put trades that I'm making in my real brokerage account. Plus, you'll get access to our monthly Ask Me Anything session and so much more. To get all this, go to my Substack at wealthbuildingwithoptions.substack.com and subscribe to the monthly or annual subscription. Now, let's tune in to higher frequency trading. All right, so episode 22, hey butthole. Let's talk about that for a second, okay? I had to call this. This story came to my mind and it was just the perfect intro to what we're talking about here today. So when I was a young lad, a clerk back in the early to mid 90s, this is probably about 1995 here. I'm dating myself big time here. But I was a clerk on the floor of the Chicago Board of Trade, and I worked for this guy. Man, I have not seen this dude in forever. I'm totally lost touch with him, mainly because he just treated me like a whipping boy and we weren't like friends or anything. But he was a good guy. He was a really good guy. He had a lot of respect for him. Very good trader. I ran into him once a few years after I worked for him at the Green Mill in Chicago, which is Chicago icon for jazz music and such. If you've never been to the Green Mill and you live in Chicago, what's the matter with you? If you don't live in Chicago and you ever go, that's where you should go if you like music. But anyway, so I'm a clerk, right? It's 1995, okay? And he was kind of grooming us to be traders. It was me and another guy, and we kind of were friends, but we were kind of like we had to compete against each other too, because one of us would become a trader, and oh god, it was a weird time. But I remember this one day, I'm standing in the pit and just kind of shadowing this guy that I work for, and he was kind of what, I don't know if you know the stereotype about floor traders, but they're kind of brash, right? This guy was the brashest ever. In fact, I think that was where I learned that word, because another one of the traders that I worked for described him as brash. And yep, you can look that up, and I think his picture is in the dictionary. But one of the things you do as a market maker, as a trader on the trading floor, is you kind of butter up the brokers, kind of buddy up with them. You kiss up to them, schmooze them, whatever you want to say, because they're the people that you're going to be trading with. They're the ones who represent customer orders, bring it down to the trading floor. And if you're a trader, that's who you're going to be trading with. And you make money by trading. So you want to be BFFs with these guys. And some of the brokers stood in the pit, and some of them were what they call floaters. And they would just like walk in the pit with an order and ask for a market. And so I remember this one time I'm standing in the pit by this guy that I work for, and one of the big brokers on the floor comes into the pit and he walks like right kind of by where we're standing. And the trader that I work for, he just looks up from his crossword or whatever at the broker and he goes, "Hey, butthole." And I was just like, aren't you supposed to be schmoozing this guy? Like, you shouldn't be pissing him off here, but I don't know. That was the environment. So anyway, this guy, he actually kind of taught me a lot. Taught me a lot about trading, I guess in a roundabout sort of way, maybe some things about life as well. And one of the things that he taught me was, I don't know if it was planned really, but he taught me about something called synthetics, which is what today's episode is going to be about. And there was this one time where I was running his Greeks. Because what would happen as a clerk, this is back in the mid 90s, before we had quite the electronic trading we have now, he would make a trade, write it up on a card. I'd go punch it into the system, and I would run back this it looked like a receipt from a restaurant or a grocery store with all his Greeks on there in his position. And he would need to know both. So anyway, he makes a bunch of trades, writes them on the cards. I go and type them in, and it's kind of a busy day, and he needed it like right now. And he's like, "Hey, how many calls am I long at the whatever strike? 100 strike. I forget what these were. I think they were bonds or something. How many calls am I long at the 120 strike?" And I look at him like, 58. And he just makes this snarl, like it looked like he was going to turn into the Hulk. And he comes storming out of the pit and he grabs the thing from me and he looks at it and he goes, "No, it's 172. Throws it on the floor and walks back into the pit. And I'm like, "What? What are you talking about?" I said, and afterwards, I ask him, I go, "Hey," this is after the market closes. "Hey, I said 58." And he goes, "Yeah, but I'm long puts too. A put's a call, a call's a put." And he just kind of walked away. And I thought about that for a second. Well, actually, I thought about it for a long time. The guys who trade down on the trading floor, the market makers, they trade what's called delta neutral. So the delta doesn't really matter of the trade. We've talked about that on the show. That's your directional risk. So it's just the gamma, theta, vega. And because they're hedging off the deltas, if you buy a call at a particular strike in a particular expiration or a put, they are both going to have about the same gamma and the same theta and the same vega. And we're going to get more to that at the end of this show. But for all intents and purposes, if you're trading delta neutral, or if you're hedging the delta at all, whether it's on a ratio or on a one-to-one basis, you can turn a put synthetically into a call and vice versa. And this is something that I touched on in my first book, Trading Option Greeks. And that is one of the things that even to this day, I mean, that book came out, geez Louise, a long time ago, probably a good 17 years ago or something like that, maybe more. And to this day, people will still sometimes quote that. A put's a call, a call's a put. Because it's a really, really important concept. It relates again to this idea of synthetics and put-call parity. So the best way to really start talking about this is just to jump kind of right into an example. Let's say that a trader owns 100 shares of $125 stock. The stock's trading right at 125 bucks. And the same trader is short one of the 125 strike calls in whatever expiration. All right. Now, I know you guys have been binging this show for a while, right? This is a 20-second episode. Or even if you haven't, if this is the first episode that you're listening to, first of all, thank you for listening. And you might know something about options already. So if I own 100 shares and I'm short one call, what is that called? Covered call, right? Okay. So got a covered call. Let's just look at this really, really simply. If we fast forward to expiration, what position would I have? Well, I would be left with one of two choices. Basically, if the stock is below the strike price, the call expires and I am just left with a stock position, right? If the stock is above the strike price at expiration, then the call gets assigned, right? It's in the owner's best interest to do that. So it gets assigned and I sell the shares of stock that I own and I got nothing left. No position at all. Below the strike, I have shares of stock. Above the strike, I have no position. That's it. That's it. Oversimplifying a little bit, you can get assigned if it's out of the money. Technically, sometimes that happens. It can be right at the strike price, blah, 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 blah. But for all intents and purposes, like that's it. You either have stock or you have no position. Okay, that's covered call. What if I am short the 125 put? There's a different scenario, okay? I mean, it's not a different scenario at all, but let's start out by assuming it's a different scenario. I'm short the 125 put, and it's probably a cash secured put. You know, I probably have cash sitting in the account, but it doesn't really matter for this example. Okay, if I'm short the 125 strike put, fast forward to expiration, and what do I have? Well, if the stock is below the 125 strike, what happens? I get assigned on that put, and I now have shares of stock. If the stock is above the 125 strike, the put expires, and I have no position. Wait a minute. Isn't that just the exact same darn thing that I just said about the covered call? Below the strike, I have stock. Above the strike, I have no position. Which one am I talking about? I'm talking about both of them, right? Doesn't matter. As long as it's the same strike price, the same expiration date on these, doesn't matter. So the question is, which one of these would you trade? If you don't have a position on now, but you want this sort of thing, hey, if it goes down, I want to be long the stock and get to keep the option premium. If it goes up, well, I don't want to buy the stock. I just want to keep the option premium. Whichever one is in your best interest, right? You would do whichever one you would get the best price from. There's something called put-call parity, which is sort of the glue that holds these two positions together that ensures that neither one would be better than the other. Because if one was a better deal than the other, everybody would do that one. And we're talking about selling the option in either case. So everybody would sell that option and the price of that option would go down to the point of where the other one becomes the best choice because that price didn't go down. That's how arbitrage scenarios work. And so this gives birth to this concept called synthetics. And the most important synthetic that we're talking about here on this show is the covered call versus the short put. And I'm going to tell you something. Back when I was a younger man teaching options to people who are newer to this, sometimes people would argue with me and they would say, no, covered call, cash secured put, they're totally different. Cash secured put, if I sell a put, that's a risky position. I mean, I have limited profit potential, but I could lose a lot if the stock goes down. It's leveraged loss. Okay. But with the covered call, you also have limited profit potential and you have all that downside risk too. Those of you who are paid subscribers and subscribe to this show, first of all, thank you very much. I appreciate that. That helps us keep the show going. So if you are not subscribed, I'd love it if you did subscribe. You get a lot of really great bonuses. Those of you who are subscribed, you have seen the P&L diagram, profit and loss diagrams drawn out, and see exactly how those work. We've talked about it on the show, but it does help to have a little bit of a visual representation. So those look exactly the same for a covered call and for a short put. They look exactly the same. And everything else is kind of basically the same too. And we're going to get to all that in a minute. A covered call is owning the stock, short the call, and then a short put is, well, short a put. What if I was short the stock and long a call? Just the opposite. Compare that with being long a put. Well, those are synthetically identical as well. What about this one? I'm long a call versus long the stock and long a put. Same strike, same expiration on the long call versus the married put or the protective put. Those are synthetic equivalents as well, as would be a short call and short stock and a short put. I don't know anybody who's ever sold a put and sold 100 shares of a stock. I'm sure there's somebody who's going to listen to the show one day who's going to write in and say, yeah, Passarelli, listen, I sell short shares of stock and sell a put all the time. What are you talking about? Fine. I just think it's less common. And then finally, we have synthetic stock, which is kind of an interesting position. That's a little less common too, but sometimes people will do this for leverage. Synthetic stock is when a trader buys a call and sells a put. Same strike, same expiration. And just think about that from an at expiration standpoint. The stock's above the strike, call gets exercised, you get 100 shares, put expires. Stock's below the strike, call expires, put gets assigned, you're long 100 shares. You're long 100 shares either way. The only difference has to do with interest on that. Because when you buy 100 shares of a stock, you're either borrowing money to buy it, so there's an interest cost, or maybe you're not. Probably you're not, but you're still not able to earn interest off that from the money market accounts in that account. There's always an interest charge whenever you own something besides having it in an interest-bearing account or own a bond or a note or whatever. So why would I buy a call and sell a put? Why would I have this synthetic stock position? Well, one of the reasons is just leverage. If I buy 100 shares of a stock, I have one or two choices. I either pay for it in full with cash, or I can buy it on margin, which means borrowing up to 50% of the value of the stock. So that would be like 2-to-1 leverage, basically, right? But if I'm buying the call and selling short a put, I might be able to do that by putting up way, way, way less capital. Now, every broker is different. Every clearing firm is different. It depends on your situation. You might have to have a certain amount of cash in your account. Depends if you're Reg T or portfolio margining. But in some cases, you might only have to put up 20% margin instead of buying a stock on 50% margin. And those words margin are different between buying a stock on margin and the margin you need to put up to carry an option position. Another reason why we might use synthetic stock is instead of shorting stock. If I short stock, which would be borrowing shares and selling it and hoping the stock goes down so you can buy it back at a lower price later, I've got to put up some amount of margin for that. And if the stock is hard to borrow, there's fees and such involved that I've got to pay, and I've got to put up some certain amount of money. Or I could sell a call and buy a put. So there's a lot of reasons for these synthetics, and we'll talk even more about them throughout this episode. But what I think is really important to get into right now are the Greeks of the synthetics and some other things like early exercise. Okay, so here I am in your earbuds or on your car radio or however it is you listen to your podcast, and I'm just telling you, oh yeah, covered call, cash secured put, they're basically the same thing. And boy, if you never thought about that, that really requires somewhat of a leap of faith. And it's not entirely fair for me just to say, oh, yeah, trust me, they're the same. Because it can be hard to wrap your head around. And to me, like, I don't ever just want to trust this bit of information. I want to deeply understand it. And I think that's important because if somebody tells me something and I try to memorize it and remember it, I'll probably forget. But if somebody tells me something and then tells me why it is that way, I'm probably going to remember it. So let's talk about the option Greeks of synthetics. And we'll start out with the delta. Let's talk about the put call pair. What is that? Well, the put call pair is at any given strike price in any given situation. There's a call at that strike and there's a put at that strike. There's a pair of these things, a call and a put. The call and the put pair, having again, same strike and same expiration as each other. Their deltas, well, let me say this, what we would call the absolute value of their deltas, which is basically just dropping the positive or negative sign. The absolute value of their deltas is usually going to add up to about 100 with equity options. With other type of options like commodities options and such, it's almost always going to add up to pretty darn close to 100. We'll talk about some reasons why that math gets a little goofed up sometimes, but they add up to basically 100. And that kind of makes sense. If you listen to some of the episodes in the past where we talked about delta, or if you read my first book, Trading Option Greeks, well, what is delta? Well, delta is how much the option moves relative to the underlying moving, right? But there's another way to think about it, and that is the likelihood of an option being in the money. Now, caveat that is not necessarily actually a mathematically correct statement, but every trader I know uses that sort of colloquially. But every trader I know uses that terminology. So, if we think about it in terms of the option expiring in the money, let's say that the call option has a 35 delta. Well, what does that mean? Well, that means that the stock has a 35% chance of being above the call's strike price, because that would make it in the money, right? Okay. Well, it's sort of a binary event. It's either above the strike price or below the strike price. And I know, technically it can be right at the strike price, but just work with me on this, will you? If it's not above the strike price, it's below the strike price. So if there's a 35% chance of it being above the strike price, there has to be a 65% chance of it being below the strike price. What does the put delta mean? Well, it means the likelihood of it being in the money, right? The put is in the money if the stock is below the strike price. So if the call has a 35% chance of being in the money at 35 delta, the put must have a 65% chance of being in the money at 65 delta. It just logically makes sense. It's not necessarily intuitive until you think about it that way. Then it's completely intuitive. You can't forget this now, right? It's ingrained in your brain. Now, theta, that's kind of the same concept, but totally different. So what is theta? For those of you who might need a little bit of review on that, theta is how much the option loses in value as time passes. Well, what if a covered call and a cash secured put are the same? Well, their thetas would have to be the same. But if you look at an option chain on your brokerage firm platform, the thetas actually aren't the same. So I know it sounds like I'm lying, but I'm not lying. There's a reason why they're not the same. And it actually mathematically makes 100% logical sense. So this again has to do with that whole crazy interest rate thing I was talking about. When professional traders short a stock, what happens? Well, when professional traders short a stock, they get interest. Technically, it is called the short stock rebate. Because when you short a stock, you borrow it from somebody and you sell it to somebody else. So you borrow it, and that just costs you some small interest like fee. And of course, you have to put up some margin on that. But then you sell it to somebody for 100% of the value, and you get that money put into your account. Again, there's a time value of money. There's always an interest rate associated with it. If that money's in your account, you earn interest on it. Now, sometimes retail traders don't always earn interest, and it depends on a lot of things. And don't hate your broker because of it. And if you do and you complain to them, don't mention my name, please. But professional traders always get this short stock rebate when they're short stock. So if the theta of the put is smaller than that of the call, which it's going to be, that's because the amount of interest they collect on the stock that they're short as a hedge against the short put, because again, they trade delta neutral, makes up for the difference in the thetas. So if the call theta is like 11 cents and the put theta is 7 cents, they're probably making 3 cents of interest on the stock. So it does actually end up being the same. Except sometimes the deep in the money puts relative to the far out of the money calls might add up to something more than 100. And sometimes when a stock is about to pay a dividend, well, not about to pay a dividend, the day before the X date, which is for all intents and purposes when you need to own the shares of stock in order to collect the dividend on the dividend payable date, the put call pair can add up to more than 100 there as well. Why is this? It's because of early exercise. And I don't want to go down a big rabbit hole here, but oh boy, I already started, didn't I? So let me follow through. With really, really deep in the money puts, what does a market maker who owns one of these deep in the money, so like nearly 100 delta puts, also have? Well, these delta neutral professional traders, if they own a put that has about 100 delta, they also own about 100 shares for each put. And if you own those shares, you're paying interest on it one way or another, aren't you? So if owning the put and the stock is synthetically the same as owning the call, if you're paying a lot more interest because you own the stock than what it would cost you to own the call, you'd be way better off just exercising the put and buying the call and not paying all that interest. Just pay the price of the call, right? And professionals do that. They do it all the time. They do the calculation. Oh, these puts are very deep in the money. Okay, I'm paying this much on interest. I'm paying maybe 12 cents a contract on interest, but I could buy the put for 5 cents. I'm going to exercise these, get rid of those so I don't have to pay 12 cents. And if I want to own the calls, I'll pay 5 cents on the calls. Okay. So the American exercise model takes that into account. And when those puts are in exercise, when it is logical to exercise those puts, it kind of creeps the delta up closer and closer to 100. As if to say, hey, you trader using me, the model, I'm trying to tell you something here. 100 delta. Look, you're supposed to exercise me, right? Now, as far as the day before the ex dividend date, here's the thing. If I own shares of a stock and the stock pays a dividend, if I'm holding that on the X date, which is the day before the date of record, the date where the company says anybody holding it on this date, we're going to pay a dividend to. Well, it takes the shares of stock a day to settle. So there's actually one day before the X date. So you have to be holding it on the close the day before the X date so that you have it in your account on the morning of the X date. I have to own those shares. But if I own the calls, I don't get the dividend. So if the calls are in the money and exercising them doesn't lead to me missing out on a lot of time premium, because remember, if I exercise an option, I lose the time premium, right? It just goes away. So if there's very, very little time premium, or specifically if the time premium is less than the dividend, minus the interest that I make on the short stock that I have against that long call. Getting a little fancy here, but that is how it works. Then I would exercise the call, throwing away the time premium, giving up future interest on that short stock, and I would get that dividend that's bigger than those two in some cases. And so therefore, the model would also take that put call pair and they would add up to more than 100 as well, because the call is an early exercise. So there you go. So early exercise is what I call math messer upper or math goofer upper. And this thing with interest and theta kind of combining on the put side and all that, yeah, it kind of makes everything a little bit messy. But when you work all these things in and go through the logic, the model really holds that put call pair together. All right. Now, look, why are we even talking about this? Do people really use this synthetic thing? Well, yes and no. I mean, look, if I want a position where if it's below the strike, I own the stock, and if it's above the strike, I have no position, but I want to keep an option premium, well, I do have two choices. I can do the cash secured put, which is usually what I would do, or I could do what's called a buy right, where I buy the stock and sell the call at the same time as part of one trade, which is what we're going to talk about next week, by the way, on the next episode anyway, if you're binging this after the fact. So it does come into play there. I might make the choice. Do I want to pay one commission on the cash secured put or two commissions on the stock and the short call? So it comes into play there, but it comes into play a lot of other ways too. There are conversions and reversals. What's a conversion or reversal? Well, a conversion and a reversal is sort of the ultimate synthetic position in a way. It's synthetic stock versus real stock. Somebody might own the call, be short the put, that's long synthetic stock, and then be short the stock. Geez Louise, why on earth would you ever do that? It's an interest play, right? There's an interest factor associated with the stock, but not really so much with the options. The price on that synthetic stock position might be close to zero. There might not be much interest there at all, just what I got to put up for margin. But more commonly, market makers will use conversions and reversals. So market makers might buy the call and sell some of the stock and then say, well, I bought the call at this price and I sold the stock at this price. If I can sell the put at this price, then I locked in the synthetic version of it for a better price than I should be, and I'm getting a theoretical profit. Oh, yes, I'll do that. There were traders who would just do that all day long in the trading pits when I traded down on the trading floor. Arbitrageurs use this stuff as well. One of the things they do is what's called synthetic straddles. They'll buy calls and they'll sell shares of stock on a ratio so that ultimately they end up with long calls and long synthetic puts, which is a straddle, and it becomes a volatility play. Vertical spreads. This kind of thing helps you manage vertical spreads great, because a call debit spread is the same thing as a put credit spread. And if you think about them that way, when the call debit spread, both options are in the money, you stop thinking about it as a call debit spread, you think about it as a put credit spread. And if you do that, you end up making better decisions. I know I'm going down a little bit of a rabbit hole giving you these examples, and it's some stuff that do you really need to know about? Well, I don't know. I mean, look, the more you learn, the more you earn. That's why you're listening to this show, right? But let's bring it back down to the issue at hand here, and that is using synthetics for covered calls and cash secured puts. In order to really further solidify the concept here, and, maybe shake out some of the skeptics that might say, oh, no, these are still, I still don't believe you, Dan. There's still two different things. Well, there's a reason why sometimes traders think about them as two different things, covered calls and cash secured puts. And there are two different reasons for that. One is timing, and the other is the strike used. So as far as timing goes, if I have a covered call, I have purchased the shares of stock. I took money, cash, that was sitting in a money market account or just sitting in my account as cash, and I bought shares of stock, and now I have those shares of stock. Don't have the cash. And then I sold a call. With the cash secured put, well, I sell a put and I hold cash in case I get assigned so that I can secure the purchase of the shares of stock with said cash. So I didn't spend that cash yet, right? Well, technically that's right, but in practice, it's really not right, because if it is a cash secured put, your broker will set that cash aside and you're not allowed to touch it. Otherwise, it doesn't become a cash secured put anymore. It becomes a naked put. And so you didn't spend the cash, but you still can't touch it. So for all intents and purposes, you don't have the cash. Either way, covered call or cash secured put, the cash is no longer available to you. And then stock's below the strike, you own the shares. Stock's above the strike, you don't. Right? You get the cash back either way if it's above the strike. So really, from a cash standpoint, it really is basically the same thing. But here's really the rub. It's the strike price used, and that is actually a pretty fair statement. Typically, if I'm trading a covered call, what is the most common way to do this, and it's not the only way to do it, but the most common way to do it is to sell a call with a strike price that is above where the stock is trading. Why? Because it gives what we call room to run, right? Room to run. The stock goes up to the strike price and you make money on the stock before getting assigned and the stock getting called away. A lot of times you want that. Not every time. I put on a covered call today where I sold basically right at the money. But a lot of the time you're doing it out of the money. And people wrap their brains around that. This is how I do that. This is what I do with the covered call. If it goes up some, I'm making money on that stock. Not just getting the option premium, getting both. But with a cash secured put, well, we typically do those out of the money also, so that the stock has to go down in order to get assigned and buy the stock at a lower price. And hey, let's be fair here. A lot of people don't use cash secured puts to buy the stock. They use them just for the skate mentality to hope to sell the put, keep the money, and the put expires. I think that's a little bit overused. Personally, we'll talk a lot about this as the show progresses. I think you should use cash secured puts to get into a stock, intentionally get assigned more than a lot of people do. But you're usually selling a lower strike either way. Hey, if I don't want to get assigned, I want to sell as low a strike as I can, still taking in as much premium as I can. I want to sell a lower strike. So I have less of a chance getting assigned. If I want to get assigned, hey, I want to get assigned in such a way where I'm buying the stock at a lower price than where it is now. And yes, that will happen even if I sell in at the money, because I get to keep that option premium, right? It sort of gets P&L'd against the strike price where I get assigned, take the strike price minus the put premium, and that's my effective purchase price, right? But if I sell even a lower strike, then, hey, I might skate if it doesn't go down. And if it does go down, oh, I'm buying on a dip. Great. So we're often using a higher strike for the covered calls and a lower strike for the cash cured puts. This put call parity thing, this synthetic thing, requires us using the same strike price for them to actually be synthetic, for them to actually be in the put call pair that makes up the put call parity. So we think about them differently, but it doesn't change the fact that if we use the same strike price, they are the same. So that is a concept that we're going to need as we go through everything else. This is one of these things that seems sort of didactic, right? Nerd, academia, detailed baloney. It seems that way. But I'm going to tell you what. Like I said before, the more you learn, the more you earn. If you really understand these synthetics and the stuff we talked about here today, you're going to be a lot better at covered calls and cash secured puts. And that about wraps it up for this show. But before you go, help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. And when you do, you will be the first to hear episode 23, where we're going to talk about buy rights and really get into that neck of the woods. I'll see you then. And in the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.